Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, June 5th. Trade news and economic data are unideal, but global equities hit a fresh all-time high level yesterday. The Bank of Canada refrained from announcing another rate cut on Wednesday, while the European Central Bank will certainly deliver its 8th rate cut decision later today. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own, and this is not financial advice. So here's a fun fact. iShares MSCI All World Index just hit a fresh all-time high level yesterday, just a few hours after the OECD cut the global growth forecast for the second time this year due to global trade uncertainties, tighter monetary conditions, and weakened consumer and business sentiment. Remember that was just a few hours ago. And add to that the rising worries among investors regarding some major economies like the US and Japan's ability to finance their ballooning sovereign debts and the recent spike that we saw in their long maturity sovereign bond yields. Well, you have a pretty murky picture out there. Now, note that even Elon Musk is growing frustrated with Trump's big and beautiful tax bill. To say he actually realized that the carnage at the Doge and the hit to his reputation around the world was simply worthless, that in fact, in the actual state of things, the US deficit is expected to grow by another $2.5 trillion with the beautiful tax bill within the next decade, but we will be reaching that $40 trillion debt mark for the US well before that, somewhere around 2030, probably, if we are lucky. But investors can't care less, that's the good news, because dips in equity markets are seen as good, excellent opportunities to buy these stocks at cheaper prices, and the economic data, though it is quite fun to watch and it somehow dilutes Trump news, somehow I say, well, remains quite secondary to the blind bullishness that we see in the financial markets today. So this is my conclusion of the post-April 2nd rally in global financial markets. The world may not be going well, but markets sure do. Now, on the trade and data front, news is not ideal. As I said, the latest news vaguely suggests that the US and the EU negotiations on trade could be on a better track these days, without, however, much details on the wire. But the US-China talks are not going quite well, with Xi Jinping, the Chinese President Xi Jinping, not willing to talk to Trump before Trump makes some concessions. So Trump is super and increasingly frustrated with China's resilient behavior. I mean, who is China to respond that way to the US, right? But China has got a very, very strong negotiation tool in its hands right now, and that's the rare metals. They actually provide around 90% of the so-called rare metals to the world that the car and several technology makers use to build their products, and they cannot build them without these rare metals. Now, quickly, these rare metals are not rare as gold or platinum, for example. You can actually find them in many places around the world. They are called rare because you cannot find them in pure or concentrated form, so you need to actually mine and refine them. And obviously, China is very, very good at doing the latter at low prices. So this is exactly why we all depend on China for these 17 rare elements. And it is said that it would actually take America 5 to 10 years to build enough capacity to provide itself enough of these rare earth metals. So China is holding a very, very important card in its hands in these trade negotiations. Just by restricting the flow of rare metals to the rest of the world, they could actually make significant economic damage. Alas, the Chinese President Xi Jinping doesn't want to sit at the negotiation table unless he sees important concessions from the US side. The concessions could be on They are technology exports, restrictions, or tariffs, anything. But at this point, there are a lot of concessions to be made to bring Xi Jinping to the negotiation table. But even then, the UK was exempt from the 50% tariffs on steel and aluminum, for example, but only for a few weeks. They are back to the negotiation table, warning that uncertainties, whatever happens, whatever the deals, won't decrease in Trump's term. It's up to investors to learn how to live with it, live with these uncertainties, and they're doing pretty well ignoring the problems, to be honest with you. But ignoring until when, right? Because yesterday's ISM data from the US show that the services activity unexpectedly stepped into the contraction zone, and the ADP data was weak as well. I mean, it was quite weak indeed, with as low as 37,000 new private jobs added last month. So if we look back over the past 4 months, 3 readings came in below the 100,000 level and 1 below the 50,000 mark. Now note that a series of below 50,000 employment reads often hint at recession knocking on the door. Happily, the significantly softer than expected ADP print of yesterday will fuel the expectations that the Fed will do what else than cut the interest rates to give support to the US economy sooner rather than later. So 2 rate cuts are expected from the Fed at this point from now to the end of the year, with the first cut, probably by September or October. But the US 2-year yield already slid below the 3.90% mark, while factoring in the rate cuts, and the latter limited a sell-off in equities yesterday. The S&P 500 closed the session flat. So that's the magic, right? If data is good, optimism rises on strong growth prospects. And if data is bad, the market optimism is still maintained on prospects of rate cuts. So the problem right now is, however, that the Fed keeps saying that it will not cut the interest rates before it sees the impact of tariffs on inflation. But that goes pretty much unheard today. The US dollar, however, seems to be one rare place where you can see the growing pessimism regarding the trade and economic implications of the trade uncertainties on the US economy. And weaker dollar helps stabilizing inflation elsewhere in the world, like in Europe, for example, where the flash CPI data pointed that the headline inflation may have eased below the European Central Bank's 2% target in May. And softening price pressures will sure give the ECB the luxury to cut its interest rates with confidence. Today, the bank is expected to lower its rates by an additional 25 basis points for the 7th consecutive monetary policy meeting and for the 8th time since the beginning of last year. Now, lower rates in Europe, combined with the European government's plans to boost their military and defense spending, backs the European growth story and backs the euro as well. Now, the single currency needs a solid reason to clear a range of thick offers between the 114.50, 115 levels, but I think that's just a matter of time before the pair breaks above this resistance zone. Now, across the Pacific Ocean, the Bank of Canada finally decided to keep its interest rates unchanged yesterday, but the latter didn't give cold feet to the USDCAD shorts that actually pushed the pair below a critical long-term Fibonacci level yesterday. The pair actually slipped below the major 38.2% Fibonacci retracement on 2021 to 2025 rise and is now consolidating in the long-term bearish consolidation zone with prospects of a further fall toward the 130-133 range in the coming months, and that despite oil prices that are pressured to the downside these days. The barrel of US crude is still above the 50-day moving average this morning, but appears to be losing that upside momentum above this critical level. Even the escalating tensions between Ukraine and Russia and a 4 million barrel decline in US weekly inventories couldn't fuel the rally above that 50-day moving average level, and the latter hints that we may have seen a peak in the recent rally into the $64 per barrel level, and a new wave of weakness could well be on the menu. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.